Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. It is the first stock pick of the day video of a brand new year. Happy New Year 2024, January 2nd. We are going to cover Intel. This is out of the information technology sector. And before we get into the video, don't forget to hit that thumbs up, hit the subscribe button, ring that notification bell so you're notified whenever we put out any new content. Join us here on this journey to financial freedom. Join the Vested Interest community, and hopefully you are on your own journey to financial freedom as well. Now, this is the Vested Interest Stock Screener. This is how I set up the stock pick of the day videos. We are going to take a look at the business first. So understand the business. Growing free cash flow will be one of the metrics we look at. Growing dividend over time. Dividend payout ratio of 75% or less. Now, this doesn't apply to REITs or BDCs. Check valuation based on dividend yield theory. We'll take a look at dividend yield theory and see if there's any potential value there. Buy below current cost basis or within 15% of its 52-week low. You're going to need to do the math on that one, but that's typically where I look to put my entry point in whenever it's within 15% of its 52-week low or lower, preferably setting a new 52-week low. Return on invested capital, return on equity equal to or greater than its industry or 10% or plus. I really focus on this 10% or plus for most companies. Another metric we're going to look at, excuse me, earnings per share growth equal to or greater than its industry average or 5% plus. Again, I really focus on this 5% plus. That's typically a pretty good metric for most companies. And if it is a financial company like a Bank of America, JP Morgan Chase, Ally Bank, if it's one of those, I do use price to book. You can use price to book for any company. Just make sure if it's not a financial company, you're looking at its industry and comparing it to some of its other competitors. For financial companies, you can just use a 1 being fair value, anything above 1 being overvalued, anything under 1 being undervalued. And overall, for the stock screener and for me personally, it must meet 5 of 8. Then it goes on my watch list, and I do more of a deep dive into the company. If it's a financial company like a bank, we add price to book in, it must meet 6 of 9. So let's jump back over to Intel. And if you want to know more about this company, check them out at www.intel.com. That's www.intel.com. That is their homepage where I pulled this information from. And their bread and butter is microchips, right? They are a microchip manufacturer, but they do have their hand in a lot of other aspects of the technology industry. Processors, FPGAs and programmable devices, select systems and devices. They have software as well as hardware, ACI accelerators, network to edge. So you can look at all the different gaming systems they're in. You may have some Intel chips in your personal computer that you're using now. So again, they are a part of our daily life. Don't think they're going anywhere. Chip manufacturing is only going to get stronger. I also like that they do have their hand in some stateside manufacturing. They are building some new plants here stateside, one in Ohio. I believe they have one out in Phoenix and one other one. I don't know where that one was at though. So they are bringing some of their manufacturing back to the States, and I really do like that. So check them out, www.intel.com, if you want to know more about the company. Now, the reason we are taking a look at them, down 4.88% on the day, huge drop on the day. We are talking about Intel Corporation, ticker INTC, closed out the day at $47.80. 52-week range, as low as $24.73, as high as $51.28. Definitely closer to its 52-week high than its 52-week low. Kudos to you if you were buying them back in the 20s. I actually sold them whenever they dropped down into the high 20s, low 30s. Because they cut the dividend. We'll see that here in a little bit, and I did not like that the week before or the month before. The management team over there said they weren't going to cut the dividend, and boom, they cut it. So this one was in my portfolio. It is not anymore. Average volume 38.8 million here. Today's was 29.9. You can clearly see that sell-off in the morning, a bit of a sell-off throughout the day overall, down the 4.88%. Market cap of $200.3868 billion, a beta of 0.95, so they are just a tick less volatile than the overall market. Here's where things start to go south. Price to earning ratio, they must be in the negative because they don't list it, so that's not good. EPS, earnings per share, is negative, so that's not good. Negative 0.39%, right? You're basically paying for negative earnings on this one, so that's not good there. Forward dividend is 50 cents paid out in the year. They are quarterly payers, so divide by 4 here. We'll see that in a minute. 99.99%, very, very low dividend yield. Like I said, they did cut their dividend. Ex-dividend date was November 6th. Looks like they paid out December 1st. And a 1-year target estimate, at least according to Yahoo Finance, where I pulled this information from, they say $35.57. So they see some further downside on this one. Now I like to get into statistics, look at dividend yield theory to see if there's any potential valuation. I will say on this one, since they recently cut their dividend, it's going to be harder to use dividend yield theory, but we're going to take a look at it anyway. 5-year dividend yield average of 2.98%. Obviously, this was before they cut their dividend, so it was a decent dividend, around 3%. You could get it over 3% at times over the last 5 years, but they drastically cut it. So now it's down to 0.99%. So since this is lower than their 5-year dividend average of 2.98%, that speaks to overvaluations. If this number was higher than their 5-year average, that would speak to undervaluation. Also, the payout ratio, even though they've recently cut their dividend, is just above the 75% metric that I look for at 75.26%. So overall, the numbers still don't look good on this one, but let's get into the financials a little bit. I like to look at free cash flow for this one here. We want growing free cash flow over time. Dividends are paid out of free cash flow, and typically if you have growing free cash flow, you have growing dividends. Other things that they can do with free cash flow, they can pay down debt, they can make acquisitions, they can reinvest back into the company. For this particular metric, we're going to look at free cash flow going back to 2020. They were at $20.9 billion. Huge drop in 2021, $9.6 billion. And even though they bought a lot of shares back, that does not account. They bought more shares back in 2020. That does definitely not account for that drop. And 2022 in the negative, $9.6 billion. Looks like they're going to be negative again in 2023. So again, overall, this is not meeting many of the metrics that I need to be able to throw this on my watch list even. Now, I always recommend more than one source, so stockanalysis.com is another one that I look at. You pick out any sources that you like out there. Just make sure you're looking at more than one so you can back check the information you're getting is accurate and up to date. Sometimes some of these companies don't update real frequently, or some update more frequently than others. So it's a good back check on the information just to make sure you're getting the most recent and most up-to-date information. Now, according to the 28 stock analysts that have taken a look at this, they call it a consensus hold. I would definitely agree on this one. It's not one I'm looking to jump into right now. Just too many negative metrics. It might be a good turnaround play. And like I said, if you were buying it back in the low 20s, high 20s, low 30s even, you've made a nice return on it. It might be time to cash in and take some of those profits off the table. But I'm not trying to tell you what to do. You have to make that decision for yourself. Excuse me. They have a low estimate of $17, which would be a 64.2% decrease from where it currently sits. Average estimate of $37.57, that would be a 20.87% decrease. And if it happened to hit their high, this is the only way you'd make any money on this one other than the dividends, it would be a $56 high at 17.94% increase from where it currently sits. Now, I like to get into statistics here. Look at the return on equity and return on invested capital. If you remember, we're looking for 10% or better. And same thing. Again, we're seeing negative numbers again. Negative 1.6% does not meet the 10% I'm looking for. Return on invested capital, negative 2.4% does not meet the 10% that I'm looking for. I also like to look at EPS growth. Sitting at now, I like 5% or better here. This does beat that metric at 19.99%, but if you remember, the EPS is currently negative. So does this 19.99% forecast bring us out of the negative, and where does that put us at? You need to do some math and do some research on that. They do expect continued revenue growth at 5.23%. Now here we're going to look at the dividend again. Payout ratio we saw was over 75%. They're saying NA here. It may be a little higher than that. I'm just going to go with 75%. Dividend growth is negative. They recently cut their dividend. That's why that's showing that way. Quarterly payer, November 20th, they were at 33. Well, we're just going to go to the most recent. Since they cut their dividend back here in 23, they obviously don't have growing dividends because they just cut it here this past year. So they were at 36 cents and fraction of a penny. Now they're down to 12 cents, fraction of a penny. They have not raised it since they did the cut last year. I don't anticipate they'll raise it this year, but they may surprise me. Well, that is it for this one. Overall, it's a no for me. I think it's overvalued. It's really run up. Like I said, if you happen to have Intel and held it through that downturn, it might be, I'm not telling you what to do, but it might be time to look at maybe taking some profits on that one. But I'm no expert. I'm just some random guy on YouTube, so you make up your own mind. Let me know what you think of Intel down below. Are you still holding? Are you looking to buy? Are you looking to sell? What are you doing with your Intel position if you have one? As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up. ring the notification bell. Most importantly, hit that subscribe button down below. Join us on this journey to financial freedom. Join the vested interest community, building a community of like-minded dividend growth investors so I can share videos like this. I do this stock pick of the day series Monday through Thursday whenever the market is open. So if you have any suggestions, I do personally read and respond to the comments down below. So if you have a company you'd like me to do in a stock pick of the day video, drop it in the comment section. I'll work it in the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Happy New Year, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and selected criteria, or seek the advice counselor, certified financial advisor.